Let's begin slowly. Good afternoon. So this is Practical Steps to Mitigate the Madness by myself, Andrew Oury, Simon Walsh.
Hi, everyone.
Ross Meadows.
Good afternoon, everyone.
Amelia Hook.
Hi, everyone.
Andrew Thomas.
Hi.
And Hugh Williams. Excellent. We are Oury Clark, multidisciplinary professional firm, trying to give some guidance to the clients through the crisis. Questions at the end, but please raise them with the buttons at any time. We did originally do them weekly. We're really doing it on a needs basis. So we think probably monthly, we will see. Previous episodes on YouTube. It is being recorded. It will be put on YouTube. We will share the slides. And this is live, as was this morning was, so slightly different questions. Thank you for hanging in there. Thank you for some of the amazing knowledge and very difficult questions that have helped drive our knowledge and hopefully some of these decisions better. And thanks for all the humour too. Thanks to the NHS. Obviously, we all need to hope that things, it will be properly funded in the future and looked after properly. The HMRC have at least recognised now that there is no inheritance tax if you die as a frontline worker, which seems very fair. As the smoke clears, we're just going to try and pick up the pieces and look forward. Beware is the word. Obviously, business is screaming for certainty, and we're a bit fed up with it after Brexit anyway. But until there is a vaccine, you know, I don't see how there can be. We don't see how there can be really. Good news, Oxford University, go Oxford, are leading the way. You may have read, it was all over the news again this morning. You know, they've done animal trials, doing human trials that finish in September. Maybe by October they could start manufacturing. There's just such a huge change. You know, will the high street be the same? Will we have cinemas? You know, someone pointed out the drive-in cinemas might be coming back. Iceland is a place that we go to a lot and support businesses from there. And we saw what happened in Iceland and, you know, 2008, 2009. It was very strange. You know, it was a very strange period, and it's taken a good 5 years to come back. You know, it's definitely going to be an interesting period. No more ping pong tables, a slight joke really, but you know, it had become a sort of ludicrous war driven from Silicon Valley to attract talent of ever more, you know, silly benefits, and maybe that's gone, and maybe that's good. You know, maybe it's back to, you know, can you pay me and can you provide me protection and meaningful benefits for me and my family. Obviously, you know, I think we're all safe in our homes, maybe going a bit mad slowly, but you know, beware, I guess, that this is going to take a long time, and, you know, years even. The government's got better to know how to react, so maybe they'll turn the depression into a recession, but the piper's going to have to be paid at some time. Taxes are definitely going to go up. It's global, as everyone keeps saying, but we don't understand pandemics. You know, they've just shut South America. The National Health Service have to be rethought. Just a little anecdote that my friend whose dad is very ill, but not from COVID, kept going to see him in St. Thomas's and couldn't understand why it was so hot. And then the staff explained they couldn't turn on the air conditioning because they can't isolate the part of the hospital with COVID. I think that shows how deep that problem is. You know, everything needs to change. In Italy, we spoke to our Italian law firm that we work with, and, you know, the government's keen to release the lockdown, wants to get the economy going, but it can't. Nobody wants to go on public transport. Kids can't go back to school. Crossrail, do we even need it now if the volumes of people constantly moving in and out of London and across London are going to drastically reduce? HS2, I'm waiting for them to say, can't afford it, sorry, we're scrapping it. You know, you will need lots of liquidity, and those who survive will reap the benefits. Some clients obviously well positioned, but for those that can't, you really, really need to innovate. But it's okay. We can get through this. Check out Wim Hof. If you've never heard of him, people kept telling me about him, so I've looked it up. And it's about innovation and cash and looking after your staff, I guess, and many other things. But the quest continues. Quick update: Cbils, major change in attitude from the banks for sub 250 £100,000 loans in the last week, maybe 2 weeks. I'm getting the word from the clients is they're becoming much more cooperative. I think the mood has shifted. It's not for startups though, you know, and unfortunately Cbils have, the European Commission, we have these concepts and rules of state aid and things. So the European Commission had to sign off on Cbils, and a key restriction has been introduced that it cannot be an undertaking in difficulty. Lenders cannot use the scheme for SMEs who have accumulated losses greater than half of their subscribed share capital. They could be very profitable at 31st of December, but if they would have been having a bad time historically, they're going to be in a difficult position. And that was sad to hear. That really was. But unfortunately, you know, there are complex underlying rules. Can you get through to your bank? Well, with difficulty, it would say. It depends if you've got a manager that you have a good relationship with and their mobile phone number. Clients who work with Barclays are having terrible times and receiving texts and things. Banks are very busy and they are not opening new bank accounts, if that gives you an indication, although they weren't brilliant at doing that for international businesses anyway. Simon, over to you. Oh, you're on mute, possibly.
Lots of people that would like me to be muted, but there you go. I'm unmuted now. Just before I kick off, there is a Q&A button on everyone's screen. So if you've got any questions that you want to pose to the panel during the presentation, please feel free to type in your questions, and then we will get to as many of them as we can at the end, time permitting. So what I'm going to talk about are just 3 government initiatives that are focused around money and cash that have been announced in the last couple of weeks. I'll talk firstly about the Future Fund, secondly about the Innovation Fund, and then about the most recent announcement by the Treasurer, the Bounce Back Fund. They're all slightly different, and there is a considerable amount of detail in the slides, and in some cases the detail that we're sharing with you is all that we know at the moment, and as with all of these things, we're waiting for further clarification from the government, and we will provide updates to our clients as they come through. But let's have a look at the Future Fund first. So essentially this is a fund where you can essentially make an application to raise between 125,000 or 5 million on which would be provided to the business as a convertible loan. But there's a number of things that you need to be aware of with the Future Fund. And the first is that the government will only provide essentially 50% of the value of the amount of money you need, because you need to find, or you need to be able to match the fund from a third party or a group of third party private investors. So for example, if you want to raise $500,000, then you need to get a commitment from private investors to put in 250,000 of that, and then you can make an application to the British Business Bank who's administering this for the government to provide the other 250K. It is provided as a convertible loan, which means that at some point the investors can actually convert that loan into equity, or that loan can be paid back. But if it is paid back, it will actually be paid back at a premium. And I'll cover off what we know about what repayment or what the paybacks look like. Who's eligible for the Future Fund? It's any unlisted UK registered company, and the government has said that that any businesses must have a substantive economic presence in the UK. Unfortunately, they've not defined what they mean as substantive, but we're expecting that will be clarified further in the rules. A couple of other things that you need to be aware of is that in order to be eligible for the Future Fund, you must already have raised at some point historically at least £250,000, certainly over the last 5 years. So you need to have already gone through some form of fundraising or in the past 5 years. As I said, there is a matching requirement, so it's not just the government that's prepared to put up cash. You have to find willing investors to put up half of the cash and or half of the loan amount that gets converted to equity. And there are some interesting things within the high level rules that might, if you've got perhaps VC money in the business at the minute, that might be slightly unnerving for some venture capitalists. So whether this is relevant to every business to some extent will depend on whether you've gone to family and friends, or whether you've raised through family or friends, or whether you're using VC or PE money already. The government has made it very clear that you can only use money available from the future fund for working capital purposes. You can't use it to pay down any debt, and you certainly can't use it to pay dividends or pay bonuses or cover external placement fees if you're going to an external party to help you raise or get things in place. So you've got the matching money there. The government has been, at this point in time, has said that there are some essentially non-negotiables in terms of the terms of the convertible loans. One of those is the interest rate. It's set at 8%. Interestingly, you can go, if you agree with your with the matching funders, you can actually go above the 8%, but you can't go below the 8%. And they have also put in place, certainly in terms of what they've published, what they see as some of the conversion rules. And the rules are such that the convertible loan will convert at the next funding round after the round where you've taken in the future fund. And in the next funding round, in order for the loan to convert, you must have raised at least the same or you must be raising at least the same amount of money as you raise through the future fund, i.e. using the example, if you're bringing in $500,000 at this point in time, then your next fundraise, in order for that conversion to happen, must be at least $500,000 or more. And the government has stipulated that when you do convert the loan to equity, there's a discount of 20% on the price. That discount can only be higher if it's agreed with the third-party investors. So that's the minimum, unless third-party investors agree. A couple of points that might be problematic for businesses is that the government stated that the loans must convert into the most senior class of equity. Some businesses may already have convertible loans in place, or they might already have agreements in their shareholders agreement that, a VC investor has the most senior class of equity. If that's the case, unless the VC is prepared to have the future fund match at the same level, that might be problematic. A couple of other traps or things that you need to be aware of as well is that if you do another funding round after you've done the conversion, and that funding round introduces a more senior class of equity, then the government can make a decision to move or to take or convert their already equity into another class. Something that you also need to be aware of as well is that the government stated that at any point in time after you have converted the loan, i.e. after the shares have been issued, the government might choose to transfer their shareholding to another third party. So we expect that at some point what the government may look at doing is essentially sort of selling all of this equity on, and that may not be that palatable for businesses that already have existing relationships with the VCs or private equity, because at the moment no one knows, and the government's not said who those third parties might be. Next slide, if you don't mind, Andy.
Oh, okay, the one, yeah, sorry.
Oh, sorry, actually, no, go back one. I was yeah. So I spoke at the onset about the fact that it's a convertible loan. You do have the option of repaying that loan, but because the government is putting this money up in the anticipation of getting a greater return at some point in the future, there is actually a slight penalty if you pay the loan off within the maturity period, which is actually 36 months. And that is that the loan, that there is a premium equal to 100% of the principal of the bridge funding. So in many cases, it's probably a deterrent to stop people just paying off the loan rather than sort of converting into equity and letting the government or whoever they hand this basket of stuff off to sort of get a carry in the upside of the equity. There will be a fairly standard set of covenants that the government will be seeking under the Future Fund. None of them are particularly concerning, and certainly are fairly consistent with most sort of debt and convertible notes that you see anyway. A couple of things to be that we're really unsure about is sort of whether existing investors who've already put money in will have an appetite to match the funding, simply because of these fairly undefined rules. Does VCA sort of care about whether the government transfers its holding to a competitive VCB at some point in the future? Big thing is that most private limited companies will have relied on EIS investment, and of course debt is not compatible with EIS, so it could impact on your EIS status. And so, there's a number of things that the government is yet to clarify. Certainly that's not one thing they're going to clarify, but certainly there's some other things that they need to clarify, I think, before we'd be encouraging people to race into these. In the last webinar that we did, we spoke a little bit about the benefit of potentially raising money through the use of an advanced subscription agreement. We've actually, on the Oury Clark website, there is a sample ASA document that you can have a look at. Essentially, what an advanced subscription agreement does is it enables a business to take in money in anticipation of converting that money into cash at some point in the future, normally in 6 months or 12 months. But the difference between the Future Fund and ASA is that the Future Fund is definitely a convertible loan, and ASA is actually not a loan, so it doesn't have an impact on EIS if you convert it within the period of time. So it's worth taking a look at that. Okay, so another fund that people have been speaking about a lot is this Innovate Fund, and it's slightly confusing in the sense that it's not actually new. In terms of the Innovate Fund is not new. At some point in time last year, the government effectively set up a competition for businesses that were very R&D focused to apply for loans where they had late stage R&D projects that hadn't yet reached their full commercial potential. And essentially what the government has done here is it's just changed some of the amount of money that's available under the Innovate Fund. But generally, in order to access that money, you need to be a participant already in the Innovative Fund program. Interestingly, they have made a statement that they will consider opening up the Innovate Fund program to other businesses, but it's questionable at this point in time as to whether they will, and you'll see that the amount of support that they're proposing to give under the Innovate Fund is fairly small, sort of at around 125k. But once again, reason why I wanted to mention it is a lot of clients have said, well, we've spoken about the Future Fund, and they said, well, what could I access money also under the Innovate Fund? And the kind of principle there is, unless you're part of that program now, there are probably better options for you. Which then brings us on to the bounce back loan. Excuse me, this was an initiative that was announced just recently, and we believe it was partly in response to the issues that businesses were having accessing Cbils. It's been given an appropriate name, a bounce back loan. And for those of you who are based in the UK, you'll probably be aware that Boris Johnson is chairing his first address, his first daily update about the coronavirus at 5 this evening. We will wait and see whether he mentions these in his address, but who knows? Anyway, they're quite interesting, but they're interesting in so much as the amounts are reasonably small. There are loans available between £2,000 and £50,000. There are some conditions attached to those, but what is most interesting is that we've been led to believe at this point in time that the application process is nothing more than 7 questions or a 2-page document that essentially, if you respond to in a positive manner, i.e. it's almost like self-certification, then the loans are almost guaranteed so long as you meet the conditions with respect to how much does a loan represent as a percentage of your turnover. And as you can see from one of the slides there, you can only borrow up to, or you can only make an application for an amount up to 25% of your turnover, and that's capped at £50,000. What we do know is that these loans will be interest-free for the first 12 months, and that repayment, the loan term is 6 years. And once again, the business must be based in the UK. It can't have been negatively affected by the coronavirus. Sorry, it must have been negatively affected by the coronavirus, but it must have not been in difficulty before the 31st of December. If you're lucky enough to have secured money under the Cbils program, though, you can't also access a bounce back loan, although you could, if you got a small Cbils grant or loan, you could actually apply to have your Cbils converted to bounce back if you think the conditions are more favourable. And on that basis, I'm going to hand back to Andy, who's going to look at some balance sheet matters. Thank you.
Thanks, Simon. Yeah, so this last point, lenders cannot use the scheme of accumulated losses greater than half of their subscribed share capital as at 31st December 2019. A very unfortunate rule. If you take this example, just giving, if you've got a bad looking company as at that point and you want a legal way to perhaps tidy up the balance sheet, waiver of connected party debt is the first suggestion. Just if you had a company here, share capital £20,000, let's say, reserve £400,000 and debt of £480,000. If we forgive the £480,000, effectively we move the company into the right position. Obviously, no one wants to forgive their debt, but particularly if it's connected party intercompany debt, for instance, it may well be the difference between the company surviving or not, and may well be a sensible measure. You do need to forgive intercompany debt under deed, but that's one option. Forgive some debt, swap debt for equity. Literally, I'm owed £1 million rather than being owed £1 million. I now have £1 million worth of shares. Again, people prefer debt generally. It depends, but generally speaking, that may not be that attractive to someone. But again, if it's the difference between the company surviving or not, you could probably make some side arrangements, share options, various other things you could come up with to try and, say, look, if we get through this and we survive, let's help you out or be generous to you. This example just showing that you just literally moving effectively debt into equity, so you end up looking fairly strong, with £100,000 say on your balance sheet. Very similar, but a slightly different way. Distressed debt. So you write the debt off and you turn it into a mix of equity and write-off. So you've got debt of 480 here. You write that off and you give them a bit of extra equity and you give them 400, as it were, of reserve. So that certainly is, one way of doing it. The other is I would look at your transfer pricing and any intercompany charges you can perhaps raise or haven't been raised. So plan A, R&D grants, go for them. You can shorten your year ends, accelerate your claim, get your money in 28 days. Government's reiterated support, sit on the panel, they've reorganized themselves, they're pushing them as hard as they can. The Innovate grants, if you can. Plan B, bounce back, Cbils. I saw in the news Ebury announced 40 million to SME business, not masses. Some VCs are still investing, but most, as you can understand, are keeping their capital safe to protect their current investments. They've got to support their current investments and not let them go under if they can. And plan C, and this isn't really a suggestion, this is just a reality, mortgage your home. We do know people, even if you've got a property overseas, as you may know, it's very hard to raise debt on when you aren't in the same place as the property. Banks don't like that. Banks don't really operate like that. HSBC, despite its advertising, can't do that. But there are specialist lenders who deal with this, who deal with the sort of specialist banks. You pay high interest rates and things, but they can lend money. But, worst case scenario, you can look at your own home. And at the moment, valuations on properties aren't really, no one can quite get their head around it. And now over to Ross.
Thanks, Andy. So we've put together some key questions and answers in relation to the coronavirus job retention scheme. It's probably useful to put things into perspective. This is the scheme that our tax office HMRC is responsible for the management and payment of, and what's to be paid under it. We base our answers off the guidance, and what I mean by the guidance is the employer and employee guidance, which is on the HMRC website. And now we've got the Treasury direction, which is the law. Unfortunately, there's conflicting advice between the law and the guidance. So what these answers aim to do is sort of cut through the crap, and we get we get what we think our view is on this. We have covered quite a few of these questions in earlier webinars, so we put detailed answers in here. So I'm not planning to go through what is furlough. I'm not going to discuss which employers on the next slide or which employees, what the grant will cover. After that, on the next slide, is what is the 80% based on. We've covered that in there, and whether an employer can just pay the 80%. The other thing that we've discussed previously, if we move on to the next slide, is how should an employer decide which employees to furlough. We've covered that in previous webinars, and we've now provided an answer which follows the Treasury direction as well. What I will talk through is the next question, which is, well, what happens after you've gone through the process of trying to seek the employee's agreement? What happens if they object to being furloughed? Well, the options you have is you could just simply impose the changes, provided you've followed the employment law principles. Then you've got two options, and this could involve dismissing and re-engaging on new terms, which means you give them notice under the contract, and at the end of the notice period you offer them the new terms, which includes the right to furlough. That's not really workable if you've got an employee with 3 months notice, because the furlough scheme at the moment ends at the end of June, so it wouldn't work for that. So probably the other option, which is basically saying that this is the lesser of two evils, that if you don't accept these changes, we're going to have to dismiss you on grounds of redundancy. One other thing to note is that employees cannot furlough themselves, but there's nothing wrong with an employer maybe volunteering for furlough, because it's something worth considering as part of every employer's review of its business. Can the employee go on and off furlough? Yes is the short answer to that. They could be put on furlough multiple times, provided there is a minimum period of 21 calendar days. Yeah, one thing to point out is furlough means no work. You can't provide them with any work. They've got to agree to carry out no work, and that period of furlough for you to be able to claim the grant must be at least 21 calendar days.
I think a question people just add to that, just to clarify, is that you can be furloughed multiple times, but you can also rotate people, Ross, is that right?
Yeah, and that's it. Can it be on a rota? So one question that was raised this morning was, can we maybe attribute this to two sales managers, where we put one on furlough for a month and then the other sales manager for the following month? Yeah, that seems a very fair process. A lot of questions have come up about annual leave and furlough, and we've now got clearer guidance on this. Originally, there was ACAS guidance, which is our employment conciliator, saying you couldn't. They quickly changed the guidance, and now we've got the guidance telling us that we can. So will employees continue to accrue annual leave during furlough? Well, that's a yes. Can it be taken? Can an employee request annual leave during furlough? Yes, is the answer to that. Now, the trickier one is, can an employer require an employee to take annual leave during furlough? That's less clear cut. There's not guidance on that. There seems to be hesitance of allowing that in the guidance, but the guidance also talks about normal employment law rules applying to furlough. So our view is that there's nothing currently stopping an employer from requiring an employee to take annual leave during furlough. What you need to do is just check how you can implement that. First of all, the first course is look at the contract. If your contracts have a clause that allows you to request employees to take holiday at any time, you can exercise that. If your contract's silent, you have to follow the statutory rules, which is give the employee 2 days notice for each day of annual leave you'd like them to take. Just bear in mind on this, the guidance does state that they'll keep these furlough provisions under review and the taking of annual leave. So that situation may change with regards to the employer. Can an employee be prevented from taking annual leave during furlough? Yes, is the simple answer. You've even without the COVID-19 crisis or the furlough rules, there's nothing stopping employers during the normal course of the year to refuse annual leave. Can an employer require employees to take annual leave once the furlough period comes to an end? Well, yes, the answer to that the question is the same, yes. You've just got to have the same considerations as I've mentioned, which is look at the contract, and if the contract's silent, give them the appropriate notice to take the holiday. What pay is an employee entitled to where they're on annual leave during furlough? The law's pretty clear on this. The first 20 days should be at full pay. Some of you may have noticed that where you've had employees already on furlough, there was 2 bank holidays recently. A lot of employers, because there wasn't guidance out at the time, have just paid them at the furlough rate. What you should have done is pay them at full pay, and we'll explain how this can be corrected in the next part. What you possibly can agree is that any holiday over the 20 days could be at the furlough subsidised rate. But my view and our view generally is pay them at full pay, just from an employee-employee relations perspective, and to avoid potential claims being brought later. If the employee's pre-arranged annual leave, which falls during furlough, can they take that leave? Yes, they can. Can they cancel that leave? No, they would need the employer's agreement. What about the effect of the reduced furlough pay on statutory pay, such as statutory maternity pay? And what about calculating furlough pay for those returning from statutory leave, such as statutory maternity pay? The basis you should calculate everything on is their actual salary, not the subsidised rate, not the statutory rate. So if someone's just returning from statutory maternity leave, they might be on 0 pay at the moment. You should base it off what their actual salary would have been, the furlough rate on the actual salary before they went on maternity leave. And for employees that returning from statutory leave that you want to furlough, again, the subsidised rate should be based on their actual salary. What if a furloughed worker becomes sick? Do they then get SSP only? Unfortunately, there's a bit of conflict between the Treasury direction and the guidance, but HMRC, when answering questions on these on the conflicting information, have said they'll try and follow the spirit of the guidance. So if we base it on the current guidance, it states that if a furloughed employee who becomes sick is moved on to statutory sick pay, the employer can no longer claim for the furloughed salary. However, if the employer keeps the sick furloughed employee on the furloughed rate, they remain eligible to claim for these costs through the furloughed scheme. So it doesn't appear like there's any advantage in an employer moving a furloughed employee onto statutory sick pay, but employers should tread cautiously. but you would have to question why you would want to pay SSP. Can an employer keep in touch with employees while they're on furlough? Simple answer to that is yes, they can. And many employers have wanting to involve them and keep them within the business in terms of virtual social events while we're staying at home. These sorts of things they can be involved in. The key here is that they must not do any work for the employer. If an employee is given notice while on furlough, what notice pay are they entitled to? There's a tricky bit of law on this, but basically, if you do give someone notice, you can still claim for the furlough pay, but you should pay them at 100%. And will it be unfair dismissal if an employer makes someone redundant rather than placing them on furlough? Unfortunately, I hate this answer, but it very much depends on the circumstances. You know, I really do hate saying this, and it's too early to determine whether tribunals will take this into account. My view is you should treat furlough as an alternative to redundancy. So you do have to consider whether furlough was a viable alternative to dismissing them. And it might be such things as, well, going forward, forgetting about the furlough pay and how long that will last for, would we look to have someone carry out this role? Or is this a role that we're probably not going to need in 12 months' time? I think if it's more of a long-term view on the role, furlough, really keeping them on furlough and retaining them, it is in itself redundant.
Very good, thanks, Ross. Amelia, you're on mute, but you are next. So off we go.
So Ross has chatted through the employment law bits of furlough. I'm going to chat a little bit more about the portal and the calculations. So the portal is now live. It's been live for about 10 days, and you access and make the claim by logging in using your government gateway on HMRC's website. You do need to be registered for PAYE for employers. If you're not, your agent can submit it on your behalf, which is what we've been doing for a load of our payroll clients. You need a load of information with employee names, national insurance numbers, and bank details, the usual stuff that you'd expect to have. But the first thing that you sort of have to decide is the claim period. And that's why we've had quite a few questions. So you can make one claim per PAYE scheme every 3 weeks. And the questions have come up a lot where clients run both weekly and monthly payrolls. You have to bunch these together, and it seems the most efficient way to do so is to do it once the payroll's been run. The payroll doesn't need to have been paid, but at least when the payroll's been run, you've got the figures to sort of base the calculation on. You can't yet amend your submission if you've made any errors, so we feel like the best place to start is to do a claim per payroll period to keep it nice and clean. The application actually makes you, for the amounts, the salary, employers, national insurance and pension, you put in as totals. So you obviously need the employee specific amounts to actually reach the totals in terms of the calculations. But what you actually input onto the portal is just the totals. The only employee specific information you need is their name and national insurance number. But that said, we really urge you to keep the backup, because if you were to get investigated or they thought there was something wrong with your claim, the backup is your defence of saying we claimed this because of X, Y, Z, rather than just bunching just because you don't have to specify per employee. We really want to hammer home that you need to keep these records for up to 5 years. The bank account address has caused a little bit of confusion. It's the portal question reads the address associated with the employer's bank account. So the Institute states that they think that's the address of the bank. The Institute of Tax says that they think it's the address of which the employer's bank statements go to. That said, we've had clients that have used both and have both received the funds, so it doesn't seem to be holding up the process. It's just something to be aware of. Unfortunately, we don't have the answer, but just wanted to raise it. There is an automatic log out after 30 minutes on the portal, and annoyingly it doesn't save the work that you've done. That's the case for whether you're putting in 1 to up to 99 employees. So my advice would be to either do a dummy run first so you know what you need to put in, or if you're really unsure, pass it to someone who does know, because you've got to sort of act quickly as you go through. 30 minutes is not a long time, especially if you've got a bunch of employees. And the last point on here, HMRC, I actually took a call from them, a couple of calls from them last week, saying that we had to clear security before they could release the funds. The lady I spoke to said that they were doing this for every claim. I'm not sure that's true, because we've had clients that have received the money without having a call. But I just wanted to emphasise the point that if you are the nominated person on your form, you don't want to be the reason why your company hasn't received the fund just because you didn't answer the phone. So if the phone's going, answer it, just in case. It's just something to be aware of. This is more sort of on the calculation as such and things to bear in mind. A common adjustment we've seen that is sort of only explained in the guidance is to do with salary sacrifice. So the headlines everywhere are sort of 80% of salary, which is true. But if employers operate a salary sacrifice scheme, commonly we're seeing with pensions, it's the taxable figure that must be used, because in this scenario their taxable pay would be lower than their salary, because they've, the employee have foregone a portion of their salary to be paid into the pension. The second question, I think, on the portal is, will the full amount from this claim be paid to the furlough employees? And this salary sacrifice is what that question's actually getting at. The grant must be used to pay employees in the form of money, and here the taxable pay is the money that they're receiving. HMRC state that normally it has to be a life event to be able to opt out of any salary sacrifice arrangement, but they do recognise that the coronavirus is a life event. So if it's something that you and or your employees want to look into, then by all means do. But the normal employment regulations must be adhered to. It has to be in the contract. So ask Ross your questions for that, not me. The second point here is qualifying earning limits for pensions. So the employee has to earn at least £520 of taxable pay for the month before you can claim the pension amount in the furlough claim. The maximum you can include is 3% of the employer's contribution, but it's just checking that actually however much the employer pays, they've got to have hit that qualifying earning limit before you can actually include it in the claim. Similarly with the ERS-NI, you have to, if you're eligible for an employment allowance, not all companies are, but if you are, that must have been fully utilised before you can claim the employer's national insurance amount. If the employer's employment allowance is £4,000 for this tax year, so if you haven't yet reached that, then you can't claim the ERS-NI until you've reached that limit. Ross touched on this as well. Furlough is calculated on calendar days. That has caused a little bit of confusion because normally payroll, we're always used to talking about working days, but it is done on calendar days, so it includes weekends, bank holidays, all that kind of stuff. I think Ross mentioned this as well, actually, that bank holidays and holidays must be payable at 100%. So if you have furloughed your employees and you're paying them 80% of their salary, that's fine. But something to bear in mind is that the bank holidays, the Easter ones we had back in April and the couple May ones we have coming up, plus any holiday that they've had in that furlough period, must be payable at 100%. If an employee's on 20k, that has not as much of an impact. But if they're, on 80, 90k, if we're doing this for cash flow, that's quite a significant difference to stump up for those days that they're for those holiday days. So it's definitely something to bear in mind. EMI and furlough. So we don't have definitive answers on this, but if you operate an EMI scheme and you furloughed employees that have EMI options, there could be a potential issue with the working time requirement. So the working time requirement considers an employee must work at least 25 hours a week, or if less, 75% of their total working time. Now, total working time takes into consideration anywhere that they've worked in any employment. So by definition, if they're furloughed, they're not working for you. If they go and take up a job working as a Tesco delivery driver or an Amazon delivery driver, that could have issues with EMI because they'd be working more time for Tesco or Amazon than the employer. We hope that wouldn't affect the validity of EMI, but we're yet to have any official guidance on that. So as and when we do, we'll keep everybody posted. My last point is on sort of limits and a couple of the things we've seen in doing the claims. I think everyone will agree with in sort of an unprecedented situation, and I think the job retention scheme is actually a really sort of an unprecedented, matches that. It's an unprecedented scheme in itself. So I think we just have to make sure that we're acting in spirit of what it's here for. We've had clients that are supposed to be furloughed that are providing all the information, answering our calls, answering our emails. That means you're working for the employer and you're not furloughed. A couple of other things we've seen is employers sort of giving employees a pay rise effective the date of their furlough. So they're sort of trying to reach up to the limit, and that's not okay. In that case, there's two ways to calculate your furloughed pay. It would either be your fixed rate, which is what you've earned throughout the last tax year, so 2019-20, or it would be a variable rate of being either what you earned in, say, for example, if you're doing the April 2020 furlough claim, it would be what you earned in April 2019, or it would be an average of your pay, which HMRC's calculator is not great for sort of different tiny little variables, but in terms of calculating average pay, it's quite an effective tool to be able to establish which figure you're allowed to use. The other point with annual payrolls is HMRC are sort of sticking to their guns on this, saying that it's quite common for small company directors to have an annual payroll, usually payable in March. If the RTI has not been submitted by the 19th of March, you don't qualify for the job retention scheme. So it's not, you can't claim the amount, even if you say you were furloughed from the 1st of March, for example. So in terms of getting the money, HMRCs do seem to be sticking to their guideline, sticking to what they say, receiving the money within the 6 days. Some clients have actually received it in less than 3 days. So it seems like the cash is actually being distributed quite quickly. The only other point I wanted to raise, which I've had quite a lot of questions in the last couple of days, is we haven't yet had the grant. We need to pay our employees today. Please, can you confirm when we're going to get it? The grant isn't there to pay your employees. It's sort of a refund of what you've paid, but you still have an obligation to pay your employees and submit the payrolls as normal. So yeah, that's about it.
Very good. I feel they could have made it a bit simpler, but perhaps it's a reflection of we don't do tax returns, so our payroll is complicated. But very good. Thank you, Amelia. Andrew, Thomas.
Okay, thanks, Andy. So we thought we'd put in a few slides just on staff and employee matters. A lot of you may have had questions from colleagues about obviously the recent weeks and implications that has for them and their family members, and people trying to get their affairs in order. So we thought we'd just cover the main employee benefits that are typically offered in the UK, starting with pension. Headlines from the pensions regulator, really it's business as usual. Your duties as an employer to continue to make pension contributions at the same rate, same percentage rate as stated in your employment contract. And even for those employees who are on furlough, then those pension contributions are expected to continue. The normal workplace duties also continue, so that point about enrolling workers at the correct time where they're eligible, and also re-enrolling workers. If you remember, you have to do this every 3 years, so that process still has to continue in the background. Don't forget, you can postpone those processes by up to 3 months. So for re-enrollment, obviously we're very busy with other matters at the moment. If your anniversary is coming up, you can push that back by 3 months. So just be aware of those dates. But for questions from employees, a lot of people will be looking at the pension statements or logging in online and have some questions about contribution rates. What are their options? Well, employees can reduce their contribution rates if they really have to, reduce the percentage, or indeed they could leave the scheme or opt out of the scheme should they really want to. Probably not a very good idea, but sometimes needs must. From an employer's side of things, you've got to be careful here not to be seen to be encouraging workers to do that or giving them inducements to leave the scheme. So it's really an employee decision. But if they come to you with questions, then you need to have some answers available for them. In terms of employer contributions, as I say, those minimum requirements do continue to be at least employer rates of at least 3% of qualifying earnings. If you're an employer that's been a bit more generous in the past and are paying higher rates than the 3%, then there is a possibility to reduce contributions to the minimum requirements. But again, be very careful here. Review what your employment contracts actually say and what you're promising. Check if the pension scheme rules will allow you to do that. And for larger payrolls, you may have to consult with employees. So be careful. Stock markets have been very volatile. We're all worried looking at our investment and pension statements about stock market falling and the impact that has on retirement funds. Certainly for younger workers, this pension account could be the first time they've been investing and the first time they've experienced this. So I think the key message to get across to workers is to be calm, not to panic, not to rush in any decisions about changing investment strategies or switching to cash and back in again. It's really a case of riding out this volatility. And for older workers, again, not to be rushed into cashing in the pension funds early or be falling prey to some of these scams that seem to be creeping up, whereby people fall foul of rogues who are out there who allow you to cash in your pension fund. So refer your employees to the FCA, who've got a very good website about how to spot scammers. So encourage people to do that. Other matters, so life cover and getting your affairs in order. Certainly through the early stages of this, we get a lot of inquiries from private clients about life cover and wills. The NHS workers now have access to a £60,000 life assurance scheme, which is great, but For the rest of employees, a lot of people are underinsured. Well, the majority of people are underinsured and do rely on their employer to provide a safety net of meaningful benefits. So really, if you don't offer group life cover for your workers, certainly I'd encourage you to do that. It's a very inexpensive benefit to offer, and it could be that a lot of your competitors are offering that to their staff. So for a few £100s a year, you could have a group policy that really provides a meaningful benefit to your workers, pays out a lump sum benefit to them should the worst happen. And a lot of these schemes come with support services to help family members, things like bereavement counselling and how to fill out probate paperwork, etc. Other than that, you could refer employees to a specialist advisor for things like wills and powers of attorney, or someone like myself for more detailed protection planning. And then finally, just to cover off other protection benefits that we're seeing being very popular now from employers offering to add to their suite of employee benefits. Income protection benefits, whereby a percentage of salary is maintained for workers if they're unable to work for long periods of time. Again, employees are very undercovered here in terms of protecting their families, covering mortgage liabilities and bills. So we're seeing a big demand from employers putting in these types of schemes. It's the market's open. Underwriters are underwriting schemes, and we can set up schemes very quickly. So very popular, alongside things like private medical cover, which is very popular. Again, things like online doctor's appointments, where we can't go to see our normal GPs. If I can dial in to a GP from my desk and get my prescription medicine sent to my local pharmacy, then it's a real benefit. And if your competitors are offering these suite of benefits, then you want to be making sure you're keeping up and attracting and retaining your good quality workers. So enough from me. I'll hand over to Hugh.
Thanks, Andrew.
Remember to unmute. Thanks, Andrew. So I thought it was good to just have a reflection on the delay tactics, some of the announcements that have been made, certainly by Companies House, around delaying your accounts. Right at the very first webinar, we struck a cautious tone here and said, you need to be thinking, if you're an audited entity, if you've got finance, if you've got bank loans existing already, there may be covenant concerns. There may be issues with signing the audit report. You're going to have to consider your going concern principles for all companies, really, and really what your disclosure is going to be. Companies House never grant extensions. I mean, it's got to be really rare situations. It's that rare that they are doing this on a pretty global scale, although you still need to apply for it. Does it make sense? Well, for all of those reasons that we talked about above, yes. I mean, it is for many the right thing to do, to just delay, just think a little bit more about what they want to put or how it will look when those are on the public record. It's not for everybody, though, and we talk about the bank covenants there. There are covenants which require you to have filed all your accounts in certain timescales. There's certain instances where we would stress, do not delay. Andy talked about it earlier. I think that, shorten your year end, get your R&D claim in, and it's sensible to put your accounts in really and accelerate that process as much as possible. So don't just automatically assume that delay is the right thing. And also, it's kind of a word of warning to our international clients. They are very public in the UK, so people can see your balance sheet. You do need to have a think, perhaps looking at representing some of those balances, a conversion to equity, and other reflections before perhaps you're lodging those accounts. Some of our clients are in different stages. I've had conversations this week about clients putting their business on ice for a short while. that's fine, but take some practical steps to prepare for it. You're going into hibernation, just like you're furloughing the company, if you like. Don't ignore some of those obligations that are there. We just passed the year end, so think about those filing requirements, the P11Ds, the tax disclosures that need to be done. The penalties will be worse if you leave them and try and come out of that later. So just take the time to just consider everything that you'll need to do in the next 3 to 6 months. Make sure that you're prepared for it, you're ready to activate it, you've set the diary reminders, and you've discussed it with us or your advisors and staff that are looking after those things. Make sure they're not missed just because you're looking to keep everything down to a bare minimum, and then fall the wrong side, really, of those fines, etc. Delay the interest. The government's picking up the 12 months interest for the first, the interest on the Cbils loans for the first 12 months. The debate raged as soon as I raised the question of, I wonder whether fixed or variable is the right way to go. We're not going to second guess here. There's huge pressures on the economy, and it will react in ways that will have economists guessing, I think. But do you delay, or do you make more certain, perhaps, rather than delay here, any variability in the rates that you'll be being charged? And sadly, there are still some difficult conversations to be had. Furlough is there to protect people and protect jobs, to come out of the hibernation, but there are still some difficult discussions, I'm sure, to be had at the end of that, around people who are sadly further redundant from that point of view. So we then move on to business as usual, or is it unusual? Taking a moment to reflect, and these are just musings here. These are conversations that some of us have had with clients already, details about what you might want to think about just going forward into this next phase. The pace has slowed now, thankfully. These webinars were once a week, and now we've taken the foot off the gas a bit because the pace has slowed about the new announcements. The pace has slowed for many of the businesses who are in that hibernation mode, but that's for some. For others, it's completely bonkers at the moment. It's just going forward at a hell of a pace. Not everything's going to emerge at the same time, and look at things like furlough. It's going to be cut at some point, and you're going to have to work out whether that means that you are back to normal or not. Whether that's going to be a gradual process, and the waking up from that hibernation is something that's going to be something you'll have to plan for as best you can in a situation that's frankly still a bit bizarre. I mean, you reflect on what the front pages and the headlines of every news channel have been over the last years, and it feels like mitigating the madness has been going on for years. The shocks, the surprises, we had it feels like the slowest rendition of the alphabet, I think. The A is for a president like no other. B is for Brexit. Oh, do you remember that time? Never a panel discussion that didn't talk about it. C, we went on to COVID, and if you have a look at our blog, we thought it might have been Corbyn, and now our latest blog, COVID's leading to a discussion about China. D, and you mentioned it earlier, we've got to be realistic about this. It's not going to look good for any of the economies of the world coming out of this. Is it a depression? And then E, we move on to the economy, surely. But the conversations are changing. And then we move on to F, and well, yeah, who knows? If it carries on at this pace, we'll be around to CZ, so that should be exciting. So some, businesses are carrying on, planning to go back. Is it going to be as normal though? Probably not. I mean, some businesses have been validating the way that they're already distributed working. It's already, there's no centre piece of an office, of a place to come together. And some have really struggled with that as we've been forced to go there. I think, talking through this with clients, are you going to jump to write a policy about how things should work if people are working from home? Or have they written the policy by pulling together and really challenging the way that they work and coming up with the ingenuity now. And there's huge examples, I'm sure, in all of your organisations, in ours, and across the board, of people really working to make it work. So embrace that, learn from that. And can you really, if you look at things like the WeWork model, can you really have a 2 metre distance in some of those offices for the number of people that are supposed to be housed? It's tough. So a few musings here, not a big consideration of all of the key aspects that you need to think of, but just some highlights. On the tax side of things, we've got, really you're going to be looking at a different style of working. Are you going to be making contributions towards staff costs? We've got broadband phone lines, we need to upgrade people. Beware, in the P11Ds, in their fringe benefit taxes, there may be something a little more that you need to consider. Staff will gladly improve their broadband, but potentially not like the tax that they'll be suffering on it at the end. So think about it, plan for it, discuss it, and bear in mind the VAT is probably blocked on that. Looking into the employment law, we go right back to the very first webinar when furlough never existed. What about when it's maybe turned off? Are you looking at changes in practices? Are you looking at different arrangements, different hours? Those kind of things, really, yeah, as Amelia said, go back and chat to Ross about them. Data protection and security, it was a big topic that we were dealing with just a couple of years ago. Most businesses have a kind of policy where in business continuity mode, some of that gets relaxed and they take a commercial risk on that. Is that realistic? It's not for 2 days. It's not, if we're carrying on working in a distributed way, you really need to think about that and work out how you can plug some of those things that you might have had to just take on the chin for now. And then you look at the other factors. I mean, they'll be particularly to you, so I'm not going to lecture on it, but it's just some thoughts about culture, about your insurances, your laptops that are out in employees' homes, and the way that people are going to be reacting to the commute in future. Are they going to want to, are they going to accept a longer one on the understanding that it's only going to be once a week? And then be disappointed if you make them come back 5 days a week, 2 years down the track. So it's potentially longer term decisions now on how you react to going back to normal. Just some thoughts.
Very good, thanks Hugh. Just to wrap up then, hang in there, it's global. Mindset is war, so there will be checking and looking back at this and retribution and all of that thing will happen. So document your decisions, define your purpose and innovate. And the UK is apparently the 5th most innovative country in the world after Switzerland, Sweden, USA, the Netherlands. I'm not quite sure how some of them got in there, but so keep your heads up, your brollies down, forecast for rain continues, and get on with innovation. Was there thanks for listening, was there any questions, Simon?
Yeah, we've got 2. First one's for Ross. Can we make staff roles redundant and run their notice period concurrently with the government's furlough scheme, provided that we make up the payment to the full salary of 100%?
Yes. Simple answer. Yes, you can.
Great. And then one more, and this is for either Ross or Amelia. I've been furloughed as of tomorrow, but I'm also the only one that can run payroll and pay staff. Next pay run is at the end of May. Am I okay to get that sorted while I'm furloughed?
My view is that's work. That's part of your duties. I don't think it's, I don't think you could argue it's anything else. Can someone else do it? If they can't, maybe you put yourself back into work for a day to do the payment at the end of the month. And so do the rota, have yourself on, have the employer put you on furlough until the payment day for payroll, and then you can go in and work a day, maybe get full pay, and then go back on furlough until the following month. It's, the furlough scheme's open to the end of June. So it'll just maybe be 2 days right at the end of each month that you're back in work.
You've nicely documented your question through this webinar, so well done. Was there another question? Sorry, Simon.
No, it was just further comment, just saying I'm also the only one with access to the bank account. Same. So But I think Ross's suggestion of perhaps going off furlough for 2 days at the end of each month to run payroll is probably the best way of handling it.
Yeah, 1 day, 2 day.
Yep.
Thank you, everyone. Thank you, Andrew.
Thank you. Cheers.
Thank you, Amelia.
Thank you.
Simon.
Thank you.
Hugh.
Thank you.
And Ross.
Thank you.
See you all later.
Bye.
Bye.